The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. Let's protect our money today. Normally I say let's make some money. It's possible to do that in what I think is a downtrend. No, I can't even really call this a downtrend. Let me call it a correction, the century correction. Let me say it that way. I need to get everybody's mind thinking bigger. Okay. I will go further into the details and into the weeds of it in another show. But I want to just talk about the S&P and do a footnote of a brief of what's going on in the near term decline, and in the next few days I'll do a bigger one from an Elliott wave theory perspective of why I put such a hellish thumbnail up there. It's not clickbait. It's not clickbait. Let's see. I am a proponent of Elliott wave theory, and the leading voice in that is a gentleman named Robert Prechter. And a while back, he gave a pretty dire forecast, saying that the recent high was the high, and that from that point forward, we would wind our way into that. Basically, the correction of the trend that started after the Great Depression. And I resisted that. I went opposite. I said, nah, we got another rise. I think in my more recent videos, I said, nah, we got another rise. In a survey of the various sectors, looking at what's going on, basically with oil and energy, has pretty much been any bright spot we've had in 2022 has pretty much been led by energy. And that historic peak in oil from 2008 of 147 barrels, well, we got to 130, and it looks like that trend is correcting. So the leader of the S&P in I would say in the last quarter has been energy, and energy is about to give up the ghost. Combine that with gold wasn't able to make a higher high, and it did what we call in the technical world a double top, and that seems to be rolling over. There's talk now about the yield curve inverting. That's like the shorter term bonds paying a higher interest rate than the longer term bonds. And so so when interest rates going, and then the Fed coming out talking about a long series of rate hikes. So that tells you they're looking at long range trends reversing. Okay. So all those dominoes have come together, and I've had to, and I'm looking at the dollar. Overall bullishness definitely is not weak, and it's looking like it has a lot higher to go. And seeing the weakness in the other currencies around the world. And you notice in none of this am I going to mention the war, because as a technical trader, our view, I would say if you're a purist, technical purist, or an advocate of Elliott wave theory, let me put it that way, be more specific, we don't believe that war and things that are temporal, say within the time frame of one president, changes the direction of trends. And it's a hard argument to make to people who don't know the rules of Elliott wave theory. But I would have to, you'd have to learn the rules to understand the logic of it, because you would see that the rules play out over. You can look over, 100 years, and you'll see the pattern, the wave pattern, complete itself despite World War. So the World War, this World War One or two, neither stopped the pattern from completing. The World Trade Center, none of that stuff stops the. There's a basically, think of it as a picture of supply and demand, but you have to think supply and demand like multi-generationally. Okay, there are consumption patterns that happen over long periods. Like we're in a trend right now in the stock market that started in 2009. So, how many presidents did you have in that period? So it's nothing that, it's not a political thing. It's unfortunate that leaders take the economy and treat it like a political football. But these trends uh, precede and follow, election terms. Governments make long-term trade agreements, to trade commodities with one another, food and energy. And so in Elliott wave theory, there's we look at those longer trend cycles, and there's a group think, like a psychology. So he calls it, Robert Preston calls it socioeconomics. So you can think of that, the intersection of sociology and economics. Okay, so there's a psychology that forms. Everybody's heard of FOMO. I'm trying to strip this down. Everybody's heard of FOMO, fear of missing out. So that's like greed. Okay, and so when prices start to rise, there's like this herding mentality, and we bid the thing, whatever the thing is that's rising, we bid it up to irrational levels. That cycle repeats over and over and over. It's nothing logical about outside of our tendency to hoard things that are in demand. So it's which affects the price, but it can only go up to a certain point where at some point in time, everyone, all the people that normally trade with the money to buy these things, own it. And one of the things you see is people that don't normally trade, they come into the game late because the high price appreciation makes the news and everything. And so that's an indicator too. So you can see that in society now, a lot of people trading everything from Bitcoin to Tesla, you name it, and they treat the stock market like an ATM machine. They don't have to know what they're doing, and they make money until it reverses, because they don't know enough to know those signs. But that's a part of the sociology of like that herding mentality. But let me what we're looking at is a picture of it. I'm going to go in a whole nother video over like the 100-year or more of Elliott of the wave count. And I've done that in my now Elliott wave theory is not perfect. Okay, it's not designed to give you the exact price. Okay, but you can go and look at the very first video I posted in 2017. I did a wave count then, so even in 2017, I was pointing towards a time in the near future when we would have a massive correction. Now, I mistakenly thought that the high in 2020 was it. So, but they're not too far off, not too much difference between then and now. And even the whatever I'm saying now is going to look better if this price does what it looks like it's going to do. But what we're looking at on screen is a picture of the futures of the S&P, and this is the low here from 2009. And in the Elliott wave theory, we would call this a wave 4. Okay, so there are 5 waves in the cycle, and this appears to be the 5th and final. And we're looking at a monthly chart. And in the chart, when you're looking at trends, the longer time frames are most significant because those trends are hard to reverse. Okay, they don't whip around that much. Our the price going up and down within a day doesn't affect this broader trend. Okay, all right. So when you start talking about breaking trends, say on a monthly chart, and these trends last, more than a year, and what we're looking at on screen here goes all the way back to 71. But when I do that longer video, we're going to go back to like the Great Depression and come to now, and I'll even show you data even before that. Show you a little bit of Robert Prechter's work. But what we have down here at the bottom, not to get too deep into it, these are momentum indicators. I have a Patreon, and some of the folks y'all see around here are in the group, and they're doing pretty well, and they're learning Elliott wave theory and some other tools of technical analysis. Technical analysis is an umbrella term. There are many schools of thought within that, and I advocate Elliott wave theory, candlestick theory, and basic price action. That's my approach, and that's what I teach on my Patreon. So if you're interested, you'll never find anywhere cheaper to learn it. And I'll say a lot of the high price teachers, I have a lot of their students. So I'll let that sit right there. Okay. I let that sit right there. It's no shade on them. I'll say this: a lot of times in those high price programs, it takes a long time to learn this stuff. It does take a commitment, and I understand why. They deserve what they're getting. I'm not no shade on charging, okay? Because I'm a good capitalist. All right, it's just that it takes longer than people expect, and you need the repetition. And someone can teach you in say a couple of months, or they can introduce you to it. Let me say it that way, because teaching implies some kind of competency. If you've been taught something, that means you know how to do it. And in a couple of months, it's not likely that you're really going to know how to do it. You're going to have familiarity with some concepts, but you're not going to really know how to do it. You need to find a tribe, hang out with the tribe, and that's what I'm offering pretty much. So anyway, this is a monthly. We see this is the current candle of March. It's trading within the range of February. It's struggling to make a high above February. It's struggling to make a high above this prior high. And we call this in technical terms a head and shoulders. Okay. This would be like the left shoulder. This would be a left. This would be like a left arm. And this would be a head. And this would be a right shoulder. And I maintain that what comes next is the right arm. Okay. Price decline. Okay, and this blue line here is again, it's the fast line of a MACD momentum oscillator. So it's showing that this whole uptrend that started in March of 2020, it's showing that the momentum, think of the momentum as gasoline. The gasoline, the fuel for this trend has reversed, where on balance there's more people leaving the trade than hanging around. Whereas here, they bought on the dip. You saw the momentum wasn't affected. fell here. Momentum wasn't affected. Now they're leaving. Okay, so this is what I was saying earlier. There's a time when psychologically people kind of collectively realize that the value is the profit has already been made, that it's time to take profit, and it's not a buy on the dip time. Now, in a broader context, the whole cycle and what's under attack in the bigger picture is this low from 2009. The near term support is here. So in the near term, I think we're going to get a decline to take us down back to where we were in December of 2020. So that would be, what's that, about 14 months? Something like that, 14, 15 months. That even that's ugly enough. But that's the best case scenario. That would be a blessing if we fell there and went on to new highs. But I don't think that's what's going to happen. I'm thinking we may fall here, find and get a little bounce, bounce off this shaded area, and I think we're going to continue falling here. I think we're going to take out the low from 2020. I think all of this is gone. This is my dire outlook. All right, I'm going to leave this until I come back in another. I'm going to leave this particular chart. I'm going to talk about oil, gold, the dollar, and the short-term interest rates. And then I'm going to wrap this video up. And then, like I said, in another video, I'm going to be looking at the S&P and Dow. I might focus on the Dow. The Dow has more price history because the Dow index is older than the S&P 500. So let's see. Let's look at, let's start with gold. Everybody loves gold. My favorite. Wow, this site is busy. I couldn't get the one I wanted. We got different exchanges listed. All right. So what we got here is a high from 2011. We fell and actually made a higher high. But you see that the momentum was going down. This will make sense once I get to the dollar chart. It will explain these anomalies. So this is called divergence. Okay. And so, more recently, we made a high in August of 2020, and we fought our way back to within $3 of a new high. Well, in trading, it's not like horseshoes. Close enough isn't good enough. You have to make a higher high. And until it actually makes a new high, gold is in trouble. Gold is in trouble. And we see here that that during this sideways movement, momentum was waning. So it's difficult for the price to rise unless these folks jump in and see value in pushing it higher. I doubt that, because a rising dollar tends to have a gold, oil, and energy. Energy and metals tend to have an opposite relationship to the dollar. So as long as money is flocking to the dollar, it's the money that's leaving oil and metals. stocks and the S&P 500. Okay, so uh, I'll be making videos about where things are going, but in short, it's your staples, it's your food inflation. It's not your imagination that your grocery bill is higher. Yes, that food on the shelf is costing more money, so we're gonna have food inflation. So commodities, that's one of that I'm sorry, staples, that sector, that's where the new investments that's going to work. That's where they are. But right now, too many people got their head on crypto and Bitcoin and Tesla and Apple and AMD and you know all of that. That's 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 the losing trade. Okay, so we're going through a thing called sector rotation, where money is moving from one sector, say the tech stocks and all the sexy stuff, to the boring stuff, the staples. Think grocery store, you know, food items. Okay. So anyway, so yeah, so this is just a picture of that, and I don't really. That's about as far as I can take you without getting deeper into some Elliott wave stuff. Let's see. So we got. Again, I'm on a weekly chart now. We're struggling this week to even take out last week. So in downtrends, prices make lower highs. So until we start making a higher high, the bias is negative. Okay. Oh, let me go back to that weekly. And this wick means price rejection. The market said, nope, that's too valuable. Okay. And this is a shooting star. It's like a reversal candle, a reversal uh, clue. Clue. Oh, let me see one more thing. You can also see that the momentum here is a whole lot lower than it was here. This is on the weekly. It's showing the same thing in that downsloping momentum I was showing before. And so there are fewer, there's less money coming into this. So it's going to be difficult for gold to drive itself higher without money support, coming in. Somebody had to value it. And so far, that's not happening. So let me go to oil. Let's go with oil futures. It's happening right now. West Texas. Okay. This is the big nasty. This is the peak we had in 2008, where oil reached $147 a barrel. If you're too young to remember this, they shut down malls. Now, at this point in time, we still had malls. Mall culture was still valid. Okay, shopping malls had not started closing yet, really. Okay, and at this point in time, the price of oil had gotten so high that the malls started shutting down because the price, how can I say this? The markup to pay for the oil, the trucking industry, shipping started cost so much money because the fuel charges that the truckers had to pay got passed on to us at the cash register. The price had gotten so high that the mall owners realized that that you would not pay that amount. The amount that they would have to charge you for the goods and services was so high, they knew that you would not pay it. And so they just told their workers to stay home and shut the mall down. Okay, so it basically broke the daggone economy pretty much. Well, this high right here, $116.65 in September of 2008. Well, we reached that. And then the market rejected it. Everybody remembers what happened before. I'm not saying that we cannot uh, make a new high. I don't think we're going to get there this time. It's just like there are two schools of thought. I have to dip into a little bit of Elliott wave theory. Elliott wave theory has retraces. Now, the big question is: are we looking at? We have corrections or retraces going ABC pattern. So think of it like a zigzag. Okay, we went to negative numbers in this futures contract for West Texas intermediate oil. Now, logically, we would think, okay, that has to be the bottom. Okay, that had to be the bottom. So if we've reached the all-time low, then we should go high, make a new high. Not necessarily. We could be in a big giant zigzag of this one leg down, a leg up, and then another low to revisit these off the chart lows. That could happen. If the dollar continues to rise, if the Fed keeps their word of having 6 or 7 interest rate hikes, it's going to destroy oil. It's going to destroy gold. And it's more likely that we could revisit this low. So that's the danger. Now, I'm on a daily chart. And I talked about the head and shoulders pattern before. It's a little mini one right here. Left shoulder, head, right shoulder. We're struggling to get past this point. We barely got past it. But we have this candle here today is called a doji. Okay. It's indecision. It's common that you see it near a directional change. Okay. So, and we got waning momentum here as well. And when we're up in this white area, that means overbought. It means it's a time where prices typically have a pullback. Now, as long as this low holds, the bulls have an argument. They're justified in being optimistic until we make a new low. Now, whereas we bears, we say, well, the fact that it wasn't able to make a new high and that the momentum is waning, that's indicative of an environment where we would make a new low. And so put me in the bear camp. Let me see something. I was looking at was it weekly? There was something. I've seen so many daggone. This is what I was looking for. This is also a picture of that left shoulder, head, right shoulder thing. All right, this nice green bullish candle, this big bull. This is a weekly chart. The low of this candle was 94.43. Well, this one went to 93.53. So all this bullishness, we gave it back. That doesn't happen in healthy uptrends. In healthy uptrends, you don't give the money back. Okay, you make a higher low and you keep going higher. The fact that this downtrend was greater than this up move, at least for this candle, that's not great. Okay, so we'll have to see what happens if this reversal happens. I think that today and tomorrow is going to be very telling. Okay, because in bullish markets, FOMO, fear of missing out, greed takes over on Friday. People are greedy and they want their money in the market because they fear missing out on a pop that might happen on a Monday. They don't want the market to open up higher on a Monday. So FOMO uh, kicks in. In bearish environments, uh, fear sets in instead, and they're afraid that Monday will be lower. So if we see blood in the streets tomorrow, we'll know that this is not a FOMO greed fueled environment. It's a fearful environment. And I think that's what's going to happen. I think that this red line showing momentum, waning momentum on us, the stochastic oscillator. I don't think that this. I think this waning momentum is to be trusted and respected. I think that's going to continue, and I think that this head and shoulders pattern is going to uh, realize itself. And then you get confirmation of the head and shoulders once we make this lower low. The problem is if we go lower here, it's going to, at a minimum, we would come down to here. I think lower. I think lower. I think lower. I think we could take everything out we go back to Thanksgiving in a hurry. So this thing could cliff dive. This doesn't look good. Okay. So I did that's all I can say on oil, but just think of it tomorrow. If it's bloody red tomorrow, especially in oil, and let me say energy, because I want to broaden it that way, because natural gas has been stellar also. A lot of money has been made this year in natural gas. So I definitely don't want to leave that out. You know. So I did gold, I did oil, did the S&P, the star of the story. Anybody remember heat wave? I'm not talking about summer. Talk about that group. Okay. All right. Let me make this point. Let me to go for the barbershop talk. People are always talking about the dollar's not worth dollar's not worth anything. Yeah, the dollar is worth something. Dollar is supposed to fall. Okay. It's not a problem. You don't want the dollar to rise. Okay. Because all of the trouble you're seeing is because the dollar is rising. It's rising. The dollar rising is a horrible thing. The dollar rising uh, destroys your equity in your home. The dollar rising makes it difficult for you to get a loan. The dollar rising makes it difficult for corporations to expand and hire new workers. So there's nothing good to you about a dollar rising. Okay. And so on this momentum oscillator, think of there's a zero line right here in the middle of the scale. Anything south of the line is weak, and anything north is positive. And the dollar's kind of been straddling the center line for a while. Okay. And so this is the dollar chart since 1971 when we came off the gold standard. And like I said earlier, the dollar has an inverse relationship to metals and energy. Your house is a collection of commodities. You got steel, copper for the electrical conduit, gypsum, You got textile for the furniture, you got aluminum for some of your appliances. It's an amalgamation of all types of um, uh, metals, minerals, materials. It's everything. And that's why stores like Home Depot and stuff like that, they're important, because you can get a gauge on how the broader economy is doing based on a lot of their sales, and home sales is key to that, because everything, a lot of different commodities go into building a home. And when those commodities um, go up in costs, that raises the price of the home. That's your price appreciation, and that's your home. That's your increased purchase price, all in one. Okay, but when the dollar starts rising, those things lose value, like oil and gold and metal, steel, all that stuff, and so does your house. And so the trend direction of the dollar and the trend direction of the interest rate, and they kind of trade together, same direction. It's like the dollar and the interest rate versus the world, versus everything, and versus all other currencies and all other commodities. Kind of think of it that way. So when your house goes up in value, it's the benefactor. Your house is the benefactor of a dollar that's nosediving. That's why you have to buy something. Uh, you can't just put your money in the bank, because inflation will kill it. You have to buy uh, precious metals, um, a house, or start a business. And if you start a business, you're using cheap money. Okay, as the dollar goes down, the interest rate goes down, you're taking that cheap money and you're investing it into the materials you need to make your widgets or whatever good or service your business provides. And you're in business basically with the bank. Okay, as much as we talk about the bank and the Federal Reserve, you're in business with them, because when they make uh, money cheap to borrow, you get to take that and build your business. You get to get that low interest rate credit card and all that stuff. And so that's the deal. But that's over now. So it looks like so anyway, this is a picture of the downtrend in of the dollar, and we broke the trend. And since 2011, the trend state of the dollar has been pretty much up or sideways. I think that we're done with this decline. Um, and this is a monthly. Uh, the dollar is slated to go much higher. Okay, so in the short term, I would say in the short term, I'm talking couple of months. We're looking there. Okay, in the longer term, we could end up revisiting these levels way back to 2010, or this level 2008. Somewhere in this range between 2008 2010, we're likely to reach those levels. That would be disastrous for oil, um, metals, all of them, not just gold, silver, copper, all of them. Okay. It would be disastrous for other currencies in the world. Okay. Because those other currencies, because their loans that they make to each other, the dollar is the default currency. So all of the loans and everything is denominated in dollars, and so uh, all the debt that's owed is in dollars. And so as the dollar starts costing more, that interest rate starts going up, that debt starts going up. Okay. And so it gets a little complicated, but basically, in short, a lot of the other currencies in the world are get extremely weak, and so as to preserve their purchasing power, a lot of central banks and any corporation or individuals that's got lots of money, they flee their country's currency and they buy US dollars because it will be going up. And so if you're for you forex traders, and you're going to see, of course, a continued weakness in the euro, the British pound, and all those other major currencies. And see the other thing, I'm trying to remember, how do I, there you go, this is what I wanted to see. And I wanted to show this is not quite it, but issue is, this is 30-year. I want 1 month. I think that's what I got. Just to show the extreme example of the interest rate. This is a treasury, 1 month treasury bond interest rate. Now we see in the longer. Remember, I showed the picture of the dollar going down. This don't go back far enough, but it's ugly. Okay, it's not supposed to, and not say not supposed to. The trend, the normal trend state is down. When it starts to rise, especially rise like right now, this took out a high from 2020, from June of 2020. So we're approaching, like, probably already might be a 2-year high in it. Okay. So this is the federal government basically raising money, making selling bonds, and with when the shorter term interest rates, like, it's like if the federal government said to you, loan me some money, you can loan me some money for 20 years, 30 years, or 30 days. I'll give you more money for the 30-day, to loan me money for 30 days, and I'll give it, then I'll pay you a higher interest rate for a 30-day loan than a 30-year loan. That makes no sense. So you're like, well, hell, why would I loan you money for 30 years if you're going to pay me more to loan it to you for 30 days? In a very, very short, crude oversimplification, that's the yield curve. Okay, it's when the shorter term interest rates are higher than the longer term ones. All right. And so all this is also just showing you how was having a shift in the macro environment, and which is fueling that sector rotation I was talking about, that's going on in the S&P. You know. And I will be talking more about that in detail, bringing up some specific stocks. So the next thing I'm going to do is the longer Elliott wave chart to show the doom and gloom of the Dow, and the by association, the S&P. They have a lot of stocks in common. The S&P is 500 stocks. The Dow is 30. The S&P is the 500 largest companies, and essentially all of them. I have to check. I think all of the Dow stocks are also in the S&P. If not all of them, most of them are. Okay, the industrials are just that, industrials. When the S&P is broader, it's more diverse. It has more industries represented. Okay. Let me see who's riding. So after I do that longer Elliott wave thing, and to scare the hell out of you, and then I'm gonna start focusing on where money can be made. Of course, for you experienced chart readers, You can buy a bear market ETF and short the market via that. If you're a newbie, I don't recommend that because you really got to know what you're doing. Because those bear market ETFs, they whip around like crazy. If you stay in it too long, it's not a set and forget thing. You have to be the type of person that likes looking at charts, that follows it kind of regularly. If you are the type that you just want to live your life, and this stuff bores the hell out of you, and you're not going to pay attention to it at least weekly, then I would say definitely talk. This is the time to talk to your financial advisor. Get one if you don't have one. Go to your credit union. Um, see what kind of free guidance you can get. It's out there. Most people don't take advantage of it. If your company, call your plan administrator for your retirement account, and if you're concerned, and have a conversation with them, and they'll, they can tell you uh, some options that you can do. If you think that the dollar, if you're convinced that the dollar is rising, and you see this interest rate rising, or the Fed, if you're concerned about what the impact to your retirement is, if the Fed raises interest rate 6 or 7 times, call up your plan administrator and have them explain it to you. Between your plan administrator and your financial advisor, you will get pointed in the right direction. And you'll also, I think, have a greater appreciation for what I'm telling you. So go let the pros tell you the impact of 6 or 7 interest rate hikes and what that's going to do to your investment in the S&P 500. Most of those S&P 500 stocks. Okay, let me see who's riding with me. What's happening, Rain and Woman? Um, yeah, that was a good video you showed on your channel last night. I showed that, to the group, uh, about a couple of weeks ago. Oh, you were right on time with that one. What's up, Osile Ostiwa? I told you to write your name phonetically, brother. Okay, Lotus Eater, what's happening? Okay, Sheed, we here. What's happening? And that's kind of all I got. But yeah, so this week is key. You know, um, watch for if prices are making higher highs. We talking about looking at weekly and daily. Did it make is the candle higher than the previous week? Or not? Look on monthly and weekly is probably better, and that's it. So the news is gonna tell you kind of after the fact, but I would say talk to your financial advisor. Okay, I'm out of here. Peace.